For anyone who has even a little bit of an interest in participating in the housing market, either as an investor or a homeowner, mortgage rates are probably on your mind because they are dictating so much of what is going on in the housing market. And some of the common questions I hear a lot are, who decides what mortgage rates are? Why are they so high? And how can I get a better rate? I don't know exactly what's going to happen, and unfortunately, I can't make rates go down. But what I can do is help you understand how rates work. I can help you understand where they come from, who is making the decisions about what mortgage rates are, and we can talk a little bit about where they may head in the coming year. And with this information, hopefully you can make an informed choice about what mortgage may be right for you. And I'm going to give you some resources and ideas about how to choose the right financing options for your next home purchase. Hey everyone, I'm Dave Meyer, Vice President of Market Intelligence at BiggerPockets, and I'm also a real estate investor. And like I said, in this video, I'm going to teach you the basics of the mortgage market, how it all works. And to do that, I'm going to switch over to my whiteboard and just sort of draw it out for all of you. Before I do that, I wanted to just let you know about two resources that we have for you. So first and foremost, if you're looking for financing, that's basically a mortgage, whether you're a homeowner, you're a real estate investor, if you are looking for some sort of financing, I've put together a free resource for you to help you pick which one is right for you. It's this sort of decision tree that lets you think about the different variables that go into picking a mortgage and identify the one that is best for your particular situation. And that is completely free. You can just go to biggerpockets.com/resources, and you'll see right at the top there's a link to download for free this tool that will help you pick the right mortgage for you. I will also put the link in the description below. The second resources that we have for you is that every month, BiggerPockets puts on a 1-hour in-depth market intelligence workshop. I'm going to be presenting information with that. There's a Q&A where I'll answer all of your questions. And this month, we're going to be diving into this particular topic. So how mortgage rates work. I'm going to go a lot more into forecasting where mortgage rates are likely to be going over this year and into the further future. And this is all free for BiggerPockets Pro members. It's happening on March 28th. So make sure to check that out again in the description below. All right, so let's switch over to the whiteboard now so I can explain to you where mortgage rates come from in the first place. All right, so let's jump into our first question here, which is, where do mortgage rates come from? And by and large, most people think the answer to this is the Fed, the Federal Reserve, right? Because they are very involved in raising or lowering quote unquote interest rates. But what the Fed actually controls is something called the federal funds rate. And this actually doesn't directly control mortgage rates. It influences them. But what it does actually control is the rate at which banks borrow from one another or borrow from the federal government. And this is important for something that we're going to talk about. But I think the first thing that you need to know is that the federal funds rate, it's about 5.25% right now. And that is not directly tied to mortgage rates, but it influences it. And I'll explain how in just a minute. But what really influences mortgage rates is banks and bond yields and how their whole business model works. So let's just take a minute and take a look at how banks work. And I'm saying banks, I mean really any sort of institution that might be lending you or creating a mortgage. But their job is to take in deposits, right? So they have savings accounts, they have checking accounts that they offer to normal people to take in deposits. They want to take all of that money in. They provide you services like ATMs and checking and online banking and all those things because what they want is your money. So the bank gets these deposits, and what are they going to do with it? Well, they need to make money off of it, and they make money off of your deposits by lending it out. And so the bank, their business model is to figure out how they can generate the most revenue by lending out the deposits that they get from all the people that use their bank. Now, a mortgage is one possible option. Small business loans, these are options. But the first thing that almost every financial institution will look to do or consider in developing their business model is lending to the federal government. And you can lend to the federal government in the form of U.S. Treasuries. So the bank can lend to the government in the form of U.S. Treasuries. You may hear these called bonds. They're the same thing. The U.S. Treasury is just the name for a U.S. government bond. Now, U.S. Treasuries come in all sorts of denominations. You can lend to the government for 3 months. You can lend to the government for 2 years. You can lend for the government for 10 years or 30 years. Those are different bond durations. But when we talk about mortgages, the one that really matters is the 10-year bond. So what we care about here is 10-year yields. And the yield is basically the interest rate or the profit that the bank could expect to earn on lending to the government. And right now, the 10-year yield is about 4.1%. I'm recording this in the middle of March. These things fluctuate day to day, but it's been around 4% plus or minus, a little bit for the last couple of months right now. And so you have to think as the bank, you have the option to get 4.1% yield on these deposits that you're collecting by lending to the U.S. government. And the reason this is important is because the U.S. government bonds are considered quote unquote no risk assets. And there is no investment in all of the world that is truly no risk. They're just called no risk assets because it is possibly the lowest risk investment that you can make. The U.S. government has never defaulted on bonds, and although there's been a lot of, debt ceiling limitations that have called that into question, to date, that has never happened. And so you have to think about, as the bank, they're saying, I could basically make 4.1% on my money with absolutely no risk. So that's one option that the bank has. But the second option here is to lend to you as a mortgage, right? And so think about how the rate of the U.S. Treasury yield, 4.1%, will impact mortgages, right? Because if you can lend to the government with no risk, the bank is probably going to have to raise the interest rate to lend to you because although I'm sure you intend to pay your mortgage, you are riskier than the U.S. government in the eyes of the bank. And so the bank adds something that we call the spread to mortgage rates. So you add the spread to that 4.1%. So they're obviously going to say, I can't lend to you at the same rate as the government. I'm going to add, and it's usually 1.9%. That's usually what the spread is. We also call this 190 basis points. You may have heard that called that as well. It's the same thing, 1.9%. So in normal times, if we had a bond yield of 4.1%, which is what we have now, and a spread of 1.9%, the normal spread, and this is also sometimes called the risk premium. It's basically the amount of interest they're adding to the normal 10-year yield in order to account for the risk of a mortgage, you would get about a 6%. But right now, the current spread is actually closer to 3%. So it's about 3%, which means that if you add our bond yield of 4.1% to 3%, that equals the 7.1% mortgages that we're seeing right now. So hopefully that makes sense to you. You take the rate that the banks could get from the government, that's the baseline. Then they add a risk premium in the form of a spread to get what they are willing to lend to you on a mortgage. Now, you're probably wondering, why is the spread normally 1.9% and right now 3%? It's due to risk. Banks see that there is inherent volatility in the economy right now. They are looking at inflation. They are looking at geopolitical risk. They're looking at risk in the banking sector from what happened last year with Silicon Valley Bank. And they're saying it is risky right now to be lending money in mortgages. The rate on a treasury is pretty good at 4.1%. So if I'm going to lend out this money in the form of a mortgage, I have to charge people more to accommodate for that risk. And that's why we have it at 3%. So hopefully you can see now that this is where mortgage rates come from. It starts with the federal fund rate, which influence bond yields. Bond yields plus the risk premium or spread that banks apply to it gets you your mortgage rate. And one more thing, before we start talking about how you might be able to get a lower rate, if you're wondering how the 10-year yield is set, that is actually a pretty complicated topic, but it is influenced by the federal funds rate, so that is super important. But it also includes things like what is happening with bond yields in other countries. It includes recession risk, how other asset classes are performing, like the stock market or cryptocurrency or commodities. And so I'm not going to get into that today, but if you want to track how and the direction that mortgage rates are going to, start learning about the 10-year yield and the direction that it's going in, because that is going to tell you a lot about the direction of mortgage rates. Okay, so let's get to our second question now, which is how can I get a lower rate? And unfortunately, as I just showed you, you can't really change the broad macroeconomic things that are impacting mortgage rates. You don't have any control over the federal funds rate or bond yields on the 10-year treasury or how much risk banks see in the market. But you can do some things to hopefully get a lower rate. I said that as of today, in the middle of March, the average mortgage rate's about 7.1%, but that's just the average, and there are ways to do a little bit better than that. So there are a couple categories. The first category is to look for government mortgages. So these are programs that are sponsored by the federal government that are aimed at supporting homeownership and making homeownership more affordable. And so a couple of them are VA loans for any active duty or former military members. So those are a really good one if you qualify for that. The next is FHA. This is a really common way that people get slightly lower mortgage rates. This is for low income people, or there are all sorts of qualifications here. So look up FHA loans if you're buying a primary residence. That's the one thing about these kinds of loans, either VA, FHA, or the USDA loan, which is the third one I'm going to talk about. All of them need to be for your primary residence. So if you're looking for an investment loan, this isn't going to work for you unless you're house hacking or doing an owner-occupied strategy. But any of these options I recommend looking into. So VAs qualify for, again, active or former military. FHA is for everyone, but there are some income restrictions. And then the USDA is for rural properties. So if you qualify for any of those things, you can look into those. The other category that you can look into to try and get a lower rate is to lower the risk for the bank, right? So we talked about how mortgage rates are set. And right now, we see that the risk premium, or that spread between bond yields and mortgage rates, is really high. So anything that you can do as an individual to lower the risk for the bank is going to be really beneficial for you. So a couple ways that you can do this is put more money down. And not everyone can do this, but if you can, this lowers the risk for a bank. If you have more skin in the game and they're lending on less of the total cost of the property, that lowers their risk, and they will be willing, in most cases, to give you a better interest rate for that exchange. The second one is to shorten the term. So most mortgages are for 30 years. That's what most home buyers in the United States use. But if you lessen the term by getting a 15-year mortgage, that lowers the risk for the bank as well, because they have less long-term inflation risk, long-term economic risk by lending to you for 30 years. If you say, I only need a loan for 15 years, that is a better prospect for that bank, and they might be willing to lower the interest rate for that. The third way to lower risk for the bank is your credit score. And this isn't something that you can do easily in a short period of time, but it's something that you can be thinking about over the long term, is to reduce and to improve your credit score, because that reduces your borrower risk to the bank, and they might be willing to give you a better rate for having that higher credit score. And then the last one is consider an adjustable rate mortgage. This is also called an ARM, but instead of fixing your interest rate for 15 or 30 years, an adjustable rate mortgage changes periodically. Usually it's locked in for 5, 7, or 10 years, and then every year it adjusts based on market rates. And as you can probably imagine, this reduces the risk for the bank, because they are willing to give you an interest rate for the first 7 years. Then after that, whatever rates are at that moment, your loan adjusts, so the bank always stays current on current rates, and they're not lending to you at a disadvantageous rate for the bank. So these are all ways right now, if you don't qualify for some of these government mortgages, or even if you do qualify for these mortgages and you want to just get the best possible rate, think in terms of how you can lower risk for the bank. And these 4 strategies are ways that you can do that. You can put more money down, you can shorten the term, you can improve your credit score, and you can consider an ARM, an adjustable rate mortgage. That's what we got for you today. Hopefully it was helpful. I think it really benefits people to understand just why mortgage rates are the way they are and think sort of like a bank, because that puts you in a position to improve your position when you go and apply for a loan, like we just talked about. If you know how the bank is thinking about mortgage rates, you can then try and lower the risk for the bank and get yourself a better rate. Now, again, if you are looking for the best loan for your personal situation, because like I said, you might not qualify for a VA loan or an FHA loan. You might not be able to improve your credit score in the time you need to get that next mortgage. So if you were questioning and wondering which mortgage option is right for you, I made a free resource for you. It's biggerpockets.com/resources. The link is in the description below. And if you want to attend my workshop on March 28th, I'm going to be going into even more depth on how mortgage rates work. And we're going to be talking a bit more about the future and where mortgage rates might be going over the next couple of years. You can do that for free if you're a BiggerPockets Pro member, or you can join BiggerPockets Pro. Just go to biggerpockets.com/pro. I hope to see you all there, but either way, I'll see you next week here on the BiggerPockets YouTube channel. Thanks for watching.